Chapter 16, Capital Expenditure Decisions, brought to you by Rachel Paul and Stuart Vick. Managers in all organizations periodically face major decisions that involve cash flows over several years. Decisions involving acquisition of machinery, vehicles, buildings, or land are examples of such decisions. Other examples include decisions involving significant changes in a production process or adding a major new line of products or services to the organization's activities. Decisions involving cash inflows and outflows beyond the current year are called capital budgeting decisions. Managers types of capital budgeting decisions. Acceptance or rejection decisions, which is whether or not to undertake a particular capital investment project, and capital rationing decisions, which is to decide which of the several worthwhile projects makes the best use of limited investment funds. This chapter is divided into three modular sections, each of which explores a particular aspect of capital expenditure decisions. Section 1 should be studied first, after which either Section 2 or Section 3 may be studied.
Learning Objective 1. Use the net present value method and the internal rate of return method to evaluate an investment proposal. Discounted cash flow analysis accounts for the time value of money. It is a mistake to add cash flows occurring at different points in time. The proper approach is to use discounted cash flow analysis, which takes into account the timing of the cash flow. There are two widely used methods of the discounted cash flow analysis, the net present value method and the internal rate of return method. Those who wish to review the basic concept of present value should read Appendix 2 on page 766 through 771 on the text before continuing. Take the example of Mountain View from the book. Currently under consideration is the purchase of a new street cleaner. The controller has estimated that the city's old street cleaning machine would last another 5 years. A new street cleaner, which would also last for 5 years, can be purchased for $50,470. It would cost the city $14,000 less each year to operate the new equipment than it costs to operate the new machine. Thus, the new street cleaner will cost $50,470 and save $70,000 over its 5-year life. Since the average savings exceed the acquisition cost, one might be tempted to conclude that the new machine should be purchased. This analysis is flawed since it does not account for the time value of money. Approach this decision using the net present value method. These 4 steps constitute a net present value analysis of an investment proposal. 1. Prepare a table showing the cash flows during each year of the proposed investment. Step 2. Compute the present value of each cash flow using a discount rate that reflects the cost of acquiring investment capital. This discount rate is often called the hurdle rate or minimum desired rate of return. Here, instead of calculating each annuity individually, we use the annuity discount factor. A discount factor for 5 periods and a discounted rate of 10% is 3.791. Now that we have the present value of the annuity of $53,074, we can compute the net present value, which is the sum of the present values of the cash flow. If the net present value is equal to or greater than 0, accept the proposal, otherwise reject it. Here we accept the proposal because the NPV is positive at $2,604.
An alternative discounted cash flow method for analyzing investment proposals is the internal rate of return method. An asset's internal rate of return or time-adjusted rate of return is the true economic return earned by the asset over its life. Another way of stating the definition is that an asset's internal rate of return, or IRR, is a discount rate that would be required in a net present value analysis in order for the asset's net present value to be exactly 0. Since the new machine would cost $50,470 and will save the company $14,000 per year in cash operating costs, this machine will last 5 years. The IRR is calculated by taking the amount of the investment and dividing it by the net annual cash inflows. This gives us a present value factor to enter into the new tables with. The annuity discount factor of 3.605 for 5 periods intersects the 12% column. 12% is the internal rate of return. The decision rule in the internal rate of return method is to accept an investment proposal if its internal rate of return is greater than the organization's cost of capital or hurdle rate. Choice of a hurdle rate is a complex problem in finance. The hurdle rate is determined by management based on the investment opportunity rate. This is the rate of return the organization can earn on its best alternative investments of equivalent risk. In general, the greater a project's risk, the higher the hurdle rate should be.
Learning Objective 2. Compare the net present value and the internal rate of return methods and state the assumptions underlying each method. The calculation of the net present value is relatively simple. The cost of capital is used as the actual discount rate and any negative value is rejected because it does not return the hurdle rate. The internal rate of return, once calculated, is compared to the hurdle rate. If the return is greater than the cost of capital, the project is acceptable. The net present value method exhibits two potential advantages over the internal rate of return method. First, if the investment analysis is carried out by hand, it is easier to compute a project's NPV than its IRR. A second potential advantage of the NPV method is that the analyst can adjust for risk considerations. Assumptions are made in discounted cash flow analysis. In both NPV and IRR, all cash flows are treated as though they occur at year-end, cash flows are treated as if they are known with certainty, and each cash flow is immediately reinvested at the required rate of return, and the discounted cash flow analysis assumes a perfect capital market.
Learning Objective 3. Use both the total cost approach and the incremental cost approach to evaluate an investment proposal. Total cost approach uses all the relevant costs of each proposal and are included in the analysis. The incremental cost approach is where just the difference in the cost of each relevant item under the two alternative systems is included in the analysis. Now let's look at another decision the City of Mountain View must make. The computing system used by the city is outdated. City Council has voted to purchase a new computing system to be funded through municipal bonds. The mayor has asked the city's controller to make a recommendation as to which of the two computing systems should be purchased. The two systems are equivalent in their ability to meet the city's needs and their ease of use. Let's make a decision. The slide shown here displays a net present value analysis of the two alternative computing systems. The exhibit uses a total cost approach in which all the relevant costs of each computing system are included in the analysis. Then the net present value of the cost of the mainframe system is compared with that of the personal computer system. Since the NPV of the cost is lower with the personal computer system, that will be the controller's recommendation to the Mountain View City Council. A decision such as Mountain View's computing system choice, in which the objective is to select the alternative with the lowest cost, is called a least cost decision. Rather than maximizing the NPV of cash inflows minus cash outflows, the objective is to minimize the NPV of the cost to be incurred. The slide shown here displays incremental net present value analysis of the city's two alternative computer systems. The result of this analysis is that the NPV of the cost of the mainframe system exceeds that of the personal computer system by $327,820. Total cost and incremental cost approaches always will yield equivalent conclusions. Choosing between them is a matter of personal preference. The accountant is often asked to predict cash flows related to operating cost savings, additional work capital requirements, or incremental costs and revenues. Such predictions are difficult in a world of uncertainty. The managerial accountant often draws upon historical accounting data to help in making cost predictions. Knowledge of market conditions, economic trends, and the likely reaction of competitors can also be important in projecting cash flows. Because of the importance of capital budgeting process, most organizations systematically follow up on projects to see how they turn out. This procedure is called a post-audit or reappraisal. Sometimes a post-audit will reveal shortcomings in the capital flow projection process. In such cases, action must be taken to improve future cash flow predictions. As in any performance evaluation process, a post-audit should not be used punitively.
Learning Objective 4. Determine the after-tax cash flows in an investment analysis. Business makes a profit is usually must pay income taxes, just as individuals do. Since many of the cash flows associated with an investment proposal affect the company's profit, they also affect the firm's income tax liability. Any aspect of an investment project that affects any of the items in this equation generally will affect the company's income tax payments. These income tax payments are cash flows, and they must be considered in any discounted cash flow analysis. In some cases, tax considerations are so crucial in a capital investment decision that they dominate all other aspects of the analysis. High Country's after-tax cash flows for 2013 are $350,000. Some expenses, depreciation being one of them, will require no cash flows, yet they reduce the amount of taxable net income.
Learning Objective 5. Use a modified accelerated cost recovery system to determine an asset's depreciation schedule for tax purposes. The Modified Accelerated Cost Recovery System, or MACRS, is a depreciation schedule created by the Internal Revenue Service in order to account for the depreciation of assets or investments. Assets are classified as 3, 5, or 7-year investments for taxation purposes. The depreciation percentage that may be taken for the classes of assets are shown in the above schedule.
Learning Objective 6. Evaluate an investment proposal using a discounted cash flow analysis, giving full consideration to income tax issues. Some investment proposals require additional outlays for working capital. Working capital, defined as the excess of current assets over current liabilities, often increases as a result of higher balances in accounts receivable or inventory necessary to support a project. Such increases are uses of cash and should be included in a discounted cash flow analysis.
Learning Objective 7. Discuss the difficulty of ranking investment proposals and use the profitability index. Suppose a company has several potential investment projects, all of which have positive net present values. If a project has a positive net present value, this means that the return projected for the project exceeds the company's cost of capital. In this case, every project with a positive NPV should be accepted. In spite of the theoretical validity of this argument, practice often does not reflect this viewpoint. In practice, managers often attempt to rank investment projects with positive net present values. Then only a limited number of the higher ranking proposals are accepted. Shown here is an example of two proposals, Project A and Project B. In this example, the total cash flows for each proposal is the same in total, but the timing of the cash flows occur differently. Since the cash flows are uneven, we must calculate the present value for each cash flow individually. Using a table or calculator to determine the present value factor, we multiply that times the first cash flow and get the present value of that cash flow. We repeat the process for the second cash flow. After calculating the present value of the third cash flow, we add them up, subtracting the initial cost of the project. The net present value of a project A is $1,020, which signals a greater return than the discount rate. Repeat the process for Project B. The net present value of the project is negative, indicating that the proposal will not return at least the discount rate. One criterion that managers sometimes apply in ranking investment proposals is called the profitability index or excess present value index.
Learning Objective 8. Use the payback method and accounting rate of return method to evaluate capital investment projects. The period of an investment proposal is the amount of time it will take for the after-tax cash flows from the project to accumulate to an amount that covers the original investment. The formula on the slide defines an investment's project's payback period. In this example, the amount of the initial investment will be recovered in 5 years. The payback method makes it appear as though an investment might recover its investment more quickly, but the method fails to consider the time value of money. Another shortcoming of the payback method is that it fails to consider an investment project's profitability beyond the payback period. Despite the shortcomings, the payback method is used widely in practice for two legitimate reasons. First, the payback method provides a tool for roughly screening investment proposals. Second, a young firm may experience a shortage of cash. For such a company, it may be crucial to select investment projects that recoup their initial investment quickly. If the payback method is used, it should be in conjunction with the discounted cash flow analysis. Cash flow methods of investment analysis focus on cash flow and incorporate the time value of money. The accounting rate of return method focuses on the incremental accounting income that results from a project. Accounting income is based on accrual accounting procedures. The formula shown on the slide is used to compute the accounting rate of return on an investment project. Myers is considering installing an espresso bar. It will cost $140,000 and have a 10-year life, generating incremental revenues of $100,000 and incremental expenses of $80,000. Accounting rate of return is 14.3%. Like the payback method, the accounting rate of return method is a simple way of screening investment proposals. Some managers use this method because they believe it parallels financial accounting statements, which also are based on accrual accounting. However, like the payback method, the accounting rate of return method does not consider the time value of money.
Objective 9. Describe the impact of activity-based costing and advanced manufacturing technology on capital budgeting decisions. The validity of any discounted cash flow analysis depends on the accuracy of the cash flow estimates. Activity-based costing systems generally improve the cost analyst's ability to accurately estimate projects' cash flows. Observers argue that for a variety of reasons, discounted cash flow analysis tend to underestimate the benefits of investing in advanced manufacturing technology.
An investment of time in this chapter will bring returns for the rest of your life.